All right, let's talk Yum Brands. Today, we're digging into their Q4 2025 earnings call, which took place on February 4th, 2026. We're going to break down what you need to know.
So here's the big puzzle from this quarter. You've got revenues that beat expectations, but earnings that missed. And the stock? It barely budged. It's a real head scratcher. So what is the real story inside the company that runs KFC, Taco Bell, and Pizza Hut? Let's get into it.
First up, let's get right into the Q4 readout. And yeah, mixed quarter is probably the best way to describe it. Like I said, it was a total split decision. On one hand, revenue looked pretty solid. It came in at $2.51 billion, which was a nice beat over the $2.45 billion the analysts were looking for. But then you look at the bottom line. Adjusted earnings per share landed at $1.73. That's a miss, just a few cents shy of the $1.76 Wall Street wanted to see. It's that classic story, right? A top-line beat with a bottom-line miss.
But when you dig a layer deeper, the story actually gets a lot more positive. If you look at the operating metrics, worldwide same-store sales grew 3%, which beat expectations. And the real engine behind that, a powerful 7% growth at Taco Bell right here in the US. So what does that tell you? It suggests that consumer demand is actually pretty healthy, maybe even healthier than that headline earnings number lets on. So you might be asking, okay, if things were pretty good, why did this stock just sit there? Well, this chart tells you everything you need to know. It's all about context. Over the past year, Yum stock was up almost 24%. It absolutely crushed both the S&P 500 and the consumer discretionary sector. So investors had already priced in a ton of good news. This means these mixed results were basically seen as in line with a story the market already understood. Okay, now let's get into the individual brands, because this is where it really feels like a tale of two completely different companies living under one corporate roof. And leading the charge, it's not even close, is Taco Bell. It is the undisputed growth engine for the entire company right now, and its performance just continues to impress. And when I say impressive, look at this. That 7% US same-store sales growth, it's huge. And what's really interesting is that they're grabbing market share from competitors across all income levels. Management is feeling so confident, they've laid out these ambitious goals for 2030, aiming for average store sales to hit around $3 million. This brand is just firing on all cylinders. All right, next up, we've got KFC. Now, it's not posting those explosive growth numbers like Taco Bell, but that's not really its job. Think of KFC as the steady global workhorse, especially when it comes to its massive scale and opening new locations. And the Colonel had a very solid year. KFC actually delivered record-breaking unit development. Get this, they hit the incredible milestone of their 30,000th international restaurant. That is just amazing scale. And all of that relentless global expansion, it drove a very healthy 10% growth in core operating profit for the division. Solid stuff. But that brings us to the other side of the story, the issue that has become the strategic center of gravity for investors. We have to talk about the persistent problem at Pizza Hut. And there is no way to sugarcoat this one. Pizza Hut continues to be the primary weak spot in the Yum portfolio. It's acting as a significant drag on the company's overall results. Period. The numbers here are just stark. Pizza Hut is now looking at 9 straight quarters of same-store sales declines. 9. To make matters worse, management is forecasting that its core operating profit is going to be down around 15% in the first quarter of 2026. The crucial takeaway here is simple. The bleeding hasn't stopped. So what's management doing about it? Well, they're not just standing still. They've launched this program called Hut Forward. It's basically a 3-step plan. First, they're doing a full strategic review of the brand, which they say will be done this year. Second, they're taking immediate action and closing about 250 underperforming stores in the US. And third, they're funding a new marketing push. The big question for everyone, though, is, will it be enough? Okay, let's pull all this together and talk about what it means for the stock going forward. This is our outlook and our official rating based on everything we saw in Q4. So when you weigh the incredible strength at Taco Bell against the very serious challenges at Pizza Hut, what's the final call on Yum brand stock? Here is our take. We expect next quarter's results will probably be pretty much in line, with no big surprises. All eyes are going to be fixed on any news coming out of that Pizza Hut strategic review. And until we get a clear catalyst from that review, like a potential sale or a truly concrete turnaround plan, we expect the stock is going to remain range-bound, effectively just trading sideways. So, because of that balance, our rating is market perform.
Think of it this way. The powerful engine of Taco Bell provides a solid floor for the stock, but the deep uncertainty surrounding Pizza Hut creates a ceiling. That's what's going to keep it performing in line with the broader market for now.
And as always, just a reminder, this is not financial advice.